As an introduction, and then we'll let you
show the progress.
Yeah, I have the points.
We conducted a poll about the economy and just now.
We'll show you the results and I'll give you. Thank you. Good afternoon once again. Good afternoon once again. A warm welcome to Mr. Shaktikanta, the Governor, Reserve Bank of India. He's been a great friend, guide and mentor of Indian industry and a policy maker who's been passionate about creating the right policy environment for India's economic growth and development. So we at CII have been fortunate to have engaged with you since the 90s during your tenure in Tamil Nadu. And thereafter, CII has had the opportunity to interact with you and work with you in different avatars for policies that were pro-growth with inclusion. I must mention that under your leadership, monetary policy measures helped India tide over the impact of the pandemic on Indian economy and fully complemented the fiscal interventions, be it the rates being kept accommodative, ensuring that the economy had enough liquidity, and ensuring credit flow to the much needy sectors such as MSMEs and other distress contact-based sectors are all commendable measures. Mr. Das, today we have a participation of more than 75 industry CEOs from across the country, representing manufacturing sector, including capital goods, consumer goods, services sector, including IT and ITES, tourism and related services, legal, accounting, and financial services. We just had a poll, and I wanted to share with you the highlights of the poll which we just did before you came. The presentation is with you. So just to give you a few feedback points which came, 57% of the CEOs indicated that they foresee a negative impact of the ongoing conflict on the business. So while that's also being shown there on the screen, so you'll see the subsequent slides are sometimes not consistent with this sentiment. On the domestic front, 83%, if I move to the next slide, 83% of the CEOs polled indicated that they anticipate a moderation in India's growth momentum during this year because of this fallout. The next point, please. So the expectation is that it will be in the range of 7.5 to 8.5. That's like 65% of the population here, which is lower than, let's say, the CII position of about 9%. If I go to the next one. So now this is where there's a bit of a disconnect from the first answer. So top line growth, 66% says better top line growth in H1 compared to the H2 of last year. Next slide. And 64% says the bottom line growth will also be better. H1 compared to H2 last year. Next slide. And 74% says investments will also be better, in FY22, better than FY22. So overall, these, I guess, are obviously positive. If I move to the next one. Again, 64%, indicate that the prospects of employment will be better. So that's again a positive feedback. And if I go to the next slide, 50% of the CEOs are of the view that exports will also be better in H2 compared to the first half of 22-23. Or rather, first half will be better than the second half of last year. If I go to the next one. Again, inflation is a concern. It's kind of split between those who feel it's a temporary phenomenon and those who think it's here to stay. If I go to the next slide. And now we come to more RBI specific suggestions, points. Again, 52% of the CEOs feel that RBI should allow for an orderly transition to a lower exchange rate. If I go to the next slide, 45% feel that RBI will maintain status quo on policy rates, and 37% expect an increase in the repo rates. Yep. And if I go to question 12, again, this is more about how do we deal with the impact of global oil prices. So again, the last 2 points are the ones which came out as suggestions. You could tick on more than one answer, and that's why you see the numbers are more than 100 in this case. So I'll now request you to, share your thoughts with us, and then we'll open it up for questions if you're okay. You want to speak for me? Yeah, sure.
Good afternoon. Shri Narendran, Chandrajit Banerjee, my old friend from Tamil Nadu days. You made a mention about 1991 Tamil Nadu. So he was in CII Chennai that time. Mr. Munjal, Sanjeev Bajaj, ladies and gentlemen, and members of the National Council of CII, members who are present here, and I can see some of them participating through the virtual mode, and they can be seen on the screen. Now, I'm actually delighted to be here this afternoon because perhaps this is the first public interaction I'm doing in the physical mode after the pandemic. I don't know whether it is right to say after the pandemic, but hopefully I'm right, and we will not see a recurrence of the kind of recurrences we have seen over the last 2 years. In fact, it is exactly 2 years today that we complete the first, experimental or the trial lockdown, a single day lockdown, which was observed on March 22nd, 2020. It was a Sunday. And I was just checking the calendar on the way. And I found that, today we are exactly 2 years, 21st March. And in last 2 years, the world has gone through a massive amount of transformation. And thanks to the developments which are now happening around Ukraine, I think the entire world is experiencing a great degree of transformation. COVID, followed by the geopolitical crisis, which has now come up around Ukraine. Technology has changed during this entire period. When the lockdown was introduced, I think there was a lot of apprehension how businesses, how government offices, and how various functions will go on in the economy. But thanks to technology, I think everything moved, and within a matter of weeks, the businesses got adjusted to it. COVID protocols were developed in our lives, in businesses, in any place which involved a congregation of more people. Even the marketing, the retail marketing also underwent substantial change. Business methods, business models have changed. COVID has produced a substantial impact on lives, livelihood, economies, and geopolitics. And economies and geopolitics, life and livelihood have also been impacted by the crisis now around Ukraine. Now, what I propose to do today is that I wish to speak for about 15 minutes or so, and I would like to just touch upon the RBI's approach during this entire period, and then come to the current situation and the way forward, the outlook. Of course, as far as monetary policy is concerned, or issues which are part of the monetary policy, I will not be able to speak much because I don't want to preempt the monetary policy's decision. And also between now and 8th of April, it's still a long way. I think in the remaining, today we are on 20, so in the remaining 17, 18 days, I think many things can change. And today it is very difficult for me it is not appropriate for me to say something on monetary policy and then find that the situation changing, and it would be appropriate I leave it for the MPC. So I will not touch upon those issues. So broadly, therefore, I will first touch upon the COVID response of the Reserve Bank. Now, our first effort when the lockdown was introduced, in fact, by the first week of March of 2020, if you recall, some cases of COVID in India had been reported in Kerala to begin with, and a few other states. And by about middle of March, it became evident that we will not be immune to this new virus. So in RBI, the first thing that we did around middle of March, around 17th, 18th of March, the first thing we did is that, we were very conscious that the financial markets, the money markets, and all the markets which are in the regulatory jurisdiction of RBI, they should function normally. So we immediately decided to set up a quarantine facility outside Mumbai in Kharghar in our data center. We sanitized the whole place. And about 200 of our employees, RBI officers, staff, and service providers, which ultimately went up to about 250, they were put in quarantine. And that time the testing protocol, etc., had not developed, but we did a general checkup and they were put under quarantine. And within just matter of 3 to 4 days, we were able to put up that quarantine facility. We had hired a hotel, entire hotel had been hired where all these 250 people were put. So that was mainly to ensure that the markets, that is the money markets, the GSEC markets, the Forex markets, they function normally, because it's quite possible that in the main, in our office, in the central office, people may get affected. So that was the first thing we did. And then going into policy around that time, also around 22nd, 23rd, we decided to advance the Monetary Policy Committee meeting. And we also decided, around that time, we did decide that, the central office building also, we decided to close down and sanitize it. And we activated our guest house, which we have in Nepean Sea Road, not far from here, which became a kind of a parallel office only for the governor, deputy governors, and a very few senior officers. So that became a parallel office from where we functioned almost for 2 months, because we didn't want too many people to come to the office and risk themselves and cause risks to others. So, and on a need basis, other people were called, or we talked to them on, on the VC mode. And the first, so therefore the first emphasis was to see that the financial markets and the financial sector, they functioned normally. Infrastructure side, we had ensured that the markets, all our the markets, they run normally through the quarantine facility. So therefore we advanced the Monetary Policy Committee meeting, and parallelly we worked out other measures. And our approach, our focus was to reduce the cost of money. So we cut interest rates by the repo rate by 75 basis points. We had to see that the financial markets, which it appeared were freezing up, there was no activity in the financial markets happening, and within matter of a week or 10 days, the financial markets appeared to be freezing up. So we decided that liquidity should not be scarce, there should be abundant liquidity. So we announced liquidity infusion measures, through this long-term repo operations, the targeted repo operations, through which we injected huge amount of liquidity. And subsequently, as we went ahead, we announced other regulatory and other kind of dispensations and reliefs. But one interesting thing which we did, learning from past experience, that almost every announcement that was made, whether excepting perhaps the rate of interest rate reduction, excepting that, any liquidity infusion or any regulatory relief which had been given in terms of moratorium or in terms of restructuring of loans, everything had a sunset date. So all these reliefs, liquidity and other support system to the economy, they had a starting date, they had an end date, because we didn't want to leave them open-ended and repeat the, the bitter experience and which we have gone through over the past. So that, whatever liquidity goes in, it comes out on a particular date. For example, the cash reserve ratio for the banks, which is normally at 4%, it was reduced to 3% exactly for 1 year. And it ended at the end of 1 year, excepting we gave some 2 weeks extension towards the end, but it ended. The liquidity we injected, most of it had a sunset date, that we are giving it for 1 year or we are giving it for 3 years. And a lot of it has in fact come back. If I can tell the figures, we announced a total liquidity support of about 17 lakh crores, over the last 2 years or so. Out of 17 lakh crores, what the banks, the small finance banks and others, they availed was about 12 lakh crores. Out of 12 lakh crores, as I speak to you today, 5 lakh crores have already come back. and rest of it will mature at the end of the third year, and some of it also will come back in the intervening period. But having done that, I would like to make it very clear with a lot of emphasis that even going forward, we will ensure that there is abundant liquidity in the market for the credit system to be active, for the credit system to function normally. And we will ensure that there is no scarcity of liquidity. There will be abundant liquidity to meet the productive requirements of the economy. So that is a clear statement which I wish to make while we are pulling out liquidity. You see, when you inject liquidity, you are entering into what various people from time to time describe as a chakra view. Everybody knows how to, a lot of people know how to enter, but very few people know how to come out. So it is therefore necessary that you have sunset dates. And so far as RBI is concerned, the day we announced that we enter into that chakra view, we planned for the exit route also. And we will come out smoothly. And our effort has been to ensure that the whole process takes place, both injection as well as withdrawal, in a very non-disruptive manner. And throughout this entire period, we have used communication as a tool of monetary policy. The idea was to give market confidence. The idea was to give forward guidance to the market, to market players, what comes next, because there was so much of uncertainty and apprehension. A lot of forward guidance had to be given. So therefore, from time to time, the monetary policy statements, which I make on behalf of the Reserve Bank and the monetary policy every 2 months, that became an instrument of communication. Monetary policy statements were earlier just about 10 minutes or so. Now the monetary policy statements are about half an hour or so, because we give a lot of forward guidance to the markets. And so communication became a major instrument in this. Our focus was also on the banking sector. In fact, throughout this period, we had to deal with the failure of a large systemic, not systemic, but a large scheduled commercial bank. The Yes Bank, the crisis came up. In fact, we were fortunate that we were able to take the measure in a very innovative way. We dealt with that problem, and just before the pandemic set in fact, the new board of directors of the Yes Bank had been put in place. Then during this period, we had challenges from, again, another small private sector bank, and the merger with DBS Bank that took place. Then we have so many other cases of few other cases of NBFCs and banks. So all of these cases, the RBI rose up to the occasion. In each and every case, we came out with innovative and new kind of solutions. So it was not, our approach in the entire period has been going beyond or looking beyond the rule book. It's not as if a problem is there and a rule is there and the rule says that if this happens, do this. Now, that's not enough when you are dealing with a pandemic related uncertainty. That is not enough when we are now looking at the new crisis, which we are now confronted with because of the war in Ukraine. So therefore, RBI has gone much beyond the rule book. We have tried to be as innovative as possible. And I must compliment my colleagues in the Reserve Bank who are risking their lives through their entire 2-year period, who have been constantly, regularly coming to office and working with me. And all of us have been working as a team. So the financial sector, we had the problem of NBFC also. There were large NBFC failures, referring them under the IBC. So therefore, and also not that, we have also during this period come out with new regulations. In the banking sector, we came out with a new governance document, which is now implemented. For the NBFCs, we have come out with a new scale-based regulation. For microfinance institutions, last week, we came out with a new regulatory framework. And now, for ARCs and for other, urban cooperative banks also, new regulatory guidelines are in the pipeline, and they will be announced in the next 1 or 2 months. And so as a result, and also throughout this entire period, in fact, I recall, I think 2020, when I interacted with the CII, I had mentioned it also at that time. I had referred to it, our effort to impress upon the banks to mobilize additional capital. And throughout 2020 and 2021, we have been emphasizing on this point, and I am happy to report that almost all banks, both public and private sector banks, have raised additional capital. And today, as I am speaking to you, the capital adequacy of banks is well above the regulatory requirements. It's about on an, at the system level, it's at 16%. The gross non-performing assets of all banks put together are at an all-time low of 6.5%. So that has been possible because of the kind of, approach which we have taken. Of course, the banks have also risen, they have risen to the occasion. They have also responded very proactively. So that I think, and also the provision coverage ratio, that is the provision the banks make for their bad assets, that also today stands at about 69%, which is a very robust figure. Now, all this has resulted that the process of recovery is now on, and the RBI for last 2 years has remained supportive of the growth, and we have resisted all temptations and all expectations and all, if I should say, all expectations and temptations, let me leave it at that, of reversing our monetary policy and moving away from accommodative stance, moving away from support to growth into a kind of a tightening regime. So we have resisted that. And there is a reason for that. Because if you recall, in 2020, for a couple of months, in 2020, I think it happened in September and October. 2021, it happened in May and June, when the inflation crossed 7% in 2020 for 2 months. And again in last year in May and June, it exceeded 6%. There was a lot of expectation, and there was a lot of analytical pressure on us through newspaper articles, magazines, articles that RBI should do this, that, but we resisted that temptation because we could clearly foresee that the inflation will moderate, and it did moderate. Because you see, the point is, if you start compressing, if you start initiating a premature demand compression through monetary policy action, then it would be counterproductive. Monetary policy addresses the demand side issues, supply side issues, which is, in inflation, there is a demand side issue, there is a supply side issue. If there is excessive demand that leads to inflation, if there are supply chain problems or supply side problems, as we have now, that is for somebody else to deal with. That is for the government to deal with. But demand side is what monetary policies world over do. Either they sort of tighten the interest rates, squeeze liquidity, and try to compress the demand. So a premature monetary policy intervention would have resulted in demand compression, and that would have been counterproductive for growth and revival. And when the economy was facing the prospect of a grim prospect of a negative growth in 2020-21, that was not the time to, think of changing your stance. The RBI continues to remain supportive of growth. What we will do in the next monetary policy is something which we will discuss. Our minds are kept open. I think some media friends are available. So I would make very clear that please don't start your interpretations. Don't take anything as a signal. Don't take anything as a signal that the RBI is thinking in terms of this or the RBI is thinking in terms of this, because I am not giving any signal or any indication. So therefore, I don't want to see a headline tomorrow that RBI is thinking of this or thinking of that. Just leave that. Let the MPC meet and the MPC will decide. But having said that, I would like to say that we are conscious of our primary responsibility of maintaining price stability, of maintaining inflation, and the inflation numbers, a lot of developments are taking place. For example, the crude prices touched $130. They came down to $99. Today, they're $112. So we really don't know how it is going to pan out. New supply chains are developing. And during this entire period, so what has happened is that everybody, I mean, you said that in your opinion poll among the CEOs, everybody expects the global growth to slow down. Everybody expects inflation to rise up. So there are also challenges coming with regard to supply side issues of shipping charges, non-availability of containers, container charges, and other kind of supply bottlenecks. But I think overall, what is happening is that the trend towards globalization today is being challenged. There are disruptions taking in the realm of globalization. But I am quite confident that the world will recalibrate and readjust to these challenges and come out of this problem as it has done in the past. At another level, we can expect some positive developments also out of, I mean, it's not the right word to say positive development, because there is loss, I mean, there is suffering, there is loss of life due to war, but certain trends can be sort of expected. And at another level, we can expect a faster transition to renewables and green energy because of these new sanctions and pressures on energy supply, particularly supply of crude and gas from Russia to other European countries. I would expect a faster transition to green energy and renewables happening in fact in all countries, because it creates so much of uncertainty with regard to availability of gas and crude. It is also possible, secondly, that there will be revival of investment on fossil fuels. Advanced countries which are, which have been talking about climate change and which had not been investing at all, or maybe investing very marginally in fossil fuel, will now be forced to invest in fossil fuel and ramp up their production capacities and actual production. But at the same time, defense expenditure is likely to be high, is likely to be higher than in the past, especially in the European countries. And that would put pressure on their budgets, that would put pressure on their fiscal. And will it be at the cost of welfare expenditure in those countries? That is something to be seen. Now, so far as India is concerned, these are not really, major issues for us. These are major issues for the European countries, which I said. But India, we have our own transition path towards renewables and towards, climate, towards green energy. And that, of course, India is well poised to achieve them. Now, looking at the current situation and looking at India's prospects, I think overall, the Indian economy is far better placed. And I'm saying it for two reasons. Number one, the high frequency indicators. And in RBI, we monitor more than 60 high frequency indicators almost on a day-to-day basis. And that includes production of, let's say two-wheelers, passenger cars, commercial vehicles, tractors. It includes things like GST collections, e-way bills issued. It also includes air freight, railway freight, air passengers, port activity. So there are about more than 60 high frequency indicators which we monitor. And today when I was looking at it, the high frequency indicators, and we look them in terms of red, orange, and green. Red, I did not see anywhere in the last column, which is the latest data we have. Excepting, I did not see red, but I saw orange in, for example, in tractors, in two-wheelers, in three-wheelers, and maybe one or two. But when it came to GST or e-way bills, or it came to, several other important activities, I find that they were in green. That means things are looking up. But again, these are numbers, and given the kind of uncertainty which we have, so we have to see how it pans out. But so far as India is concerned, even now the high frequency indicators of economic activity broadly look, they're in the green zone. The other thing which is very important, if you compare ourselves with the 2019 taper, 2013 taper, when we, unlike the 2013 taper tantrum, unlike 2013, today, we have, in the run-up to the current crisis, crisis, meaning because of the war in Ukraine, in the run-up to the current crisis, our current account deficit is very, very low. And secondly, our Forex reserves are very high. Over the last 3 years, our Forex reserves have gone up by almost $270 billion or so. In January 2019, it was about just little below $400 billion. Today, as we are talking here, we have foreign exchange reserves. The latest data is 622 billion US dollars. That is already a published figure. Other than that, we hold a lot of Forex in our forward assets, which will mature from time to time every month. And today we are holding about 50 to 55, in fact, to be precise, 55 billion US dollars. We are holding it in the forward market, and they will all come back to us in the coming months. So 622 plus 55, our reserves are 677 billion US dollars. India is comfortably placed to deal with any effect of spillover or any challenge with regard to financing of current account deficit is concerned. So economy is better placed today. On the external sector also we are better placed, but we are living in an uncertain world. There is no reason for complacency. We have to be watchful, and we are monitoring this very closely. We are also monitoring the crude and commodity prices, the volatility. Very closely, we are watching them. Worries have been expressed in certain quarters and in several quarters about, the inflation going up in India. As I pointed out earlier, similar situations prevailed in 2020. It also prevailed in 2021. Today, again, the inflation for the last 2 months has been 6%. Whether it is the situation is similar, only time will tell. Our earlier estimate, which we had given about the inflation scenario, we were looking at inflation, CPI inflation to be 4.5% by March of 23. Now we have to watch. I will not like to comment what is our expectation on inflation and growth, because that is something which I would like to leave for the monetary policy. But having said that, I would like to very emphatically say that while we are watchful and monitoring all the trends, international, global trends, regional, domestic trends, with regard to economic activity, with regard to inflation, with regard to growth, we are watchful, but at the same time, I can say that we stand committed, and we are confident of dealing with any emerging situation and dealing with any emerging challenge. That kind of commitment and confidence is there in the Reserve Bank. As we have done in the past, we are confident that we will be able to do it in the future also. So I'll stop here. Thank you very much.
Thank you, Mr. Das, for a very positive and reassuring speech. A few points before I open it up for the Q&A. Firstly, the support of 17 lakh crore that you talked about was timely and done in the most pragmatic manner. Thank you for that. We also heartened by your assurance on sufficient liquidity. I think that's always a concern of industry, so it's good to hear that. We also see that RBI is buying the rupee and selling dollars, and that's also something which is sometimes comforting for the industry. And your assurance on forward guidance is also very important. And you talked about the Chakra view. I think India has been a good example of how it has got in and got out of the situation. So thank you very much for that. I'm going to open it up for Q&A. So we'll probably do 3 questions at a time so that you can respond and then address the others. So first from Uday. Yeah.
Good afternoon, sir. I must say that the RBI's role in the last 2 years to ensure systemic stability and protect the country has been phenomenal. And I can say as a practitioner, it has truly, in many ways, saved India and helped it navigate through the last 2 years. I'm going to go back to February 10 statement of yours, sir. And this was on the backdrop of the demise of Lata Mangeshkar. And I will quote from your statement. Quote, as the great Lata Mangeshkar, whom we lost recently, sang in her immortal song, "Aaj fir jeene ki tamanna hai." Together with the spirit behind behind the next line of this beautiful song, she has conveyed an eternal message of optimism. Closed. For the benefit of the audience, the second line of Lata Mangeshkar's song was, "Aaj fir marne ka irada hai." So the two lines went, "Aaj fir jeene ki tamanna hai, aaj fir marne ka irada hai." Maybe it was prescient in terms of the Russia-Ukraine crisis very soon after that wonderful quote which you made, sir. So at this stage, both the lines are very interesting lines. Therefore, from the point of view of all the risk takers here, as well as from the point of view of policymakers who take the risk, which of the two lines would you think we should be thinking about as this point of time? "Aaj fir jeene ki tamanna hai, aaj fir marne ka irada hai."
Can I take two more questions? Rishad?
Thank you, Governor Das, for those thoughtful comments. You know, in the context of what's happened in the last few weeks, you talked about the Ukraine crisis, the extreme volatility of oil, Fed tapering, which has begun, the commitment to increase, Fed rates over the next 6 to 8 times over the next year. In this context, what do you foresee in terms of the challenges for currency more generally and the rupee in particular?
Thanks, Rishad. Nadir?
Thank you very much for keeping the Indian economy on a stable level. And I entirely agree with you that supply side inflation cannot be cured by demand side problems. And as you rightly said, that this commodity and food inflation gives us an opportunity both to promote green energy as well as Indian agriculture. We are importing a lot of vegetable oil and some other commodities, and it's a great opportunity to grow more in our country. So my question to you is, will there be any special schemes for favorable interest rates to green energy or for agriculture? Thank you.
Would you like to respond or should I?
You see, the last question, I will reply first. Now, we don't have, if any interest subvention or any interest subsidy has to be given, the government gives it from time to time. The government has various schemes. For example, in the agriculture sector, for the crop loans, there is an interest subsidy and the loan is available, at about 4%. In fact, some states also give a further subsidy on that, and the rates of interest are low, even lower than 4%. Now, so far as RBI's regulatory framework is concerned, we don't give sectoral, we don't set sectoral interest rates. Interest rates are completely deregulated. It is left to the lender, whether it is a bank or NBFC or any other entity which is in the lending business. It's for them to determine the rate of interest depending on their cost of funds and their other overhead charges and their risk assessment of individual borrower or borrowers belonging to a particular sector. So therefore, so far as RBI is concerned, that is the position. We will not, the RBI will, because it's not a part of our policy, it lies in the realm of the fiscal policy. And also, by and large, a general point which I would like to mention is that anything which is built on, too many support measures, too many SOPs, I think right from the beginning, that particular business or that particular activity develops certain inherent weaknesses. So in the long term, it may not be really good for a business to start by leaning on somebody. You need some initial support, especially the small units, I agree. But I think leaning on some external support like interest rate subvention, etc., it sort of injects or you're also putting in seeds of inherent weakness in that business. Now, with regard to the challenges in currency, now, as I mentioned, our Forex reserve figures I mentioned, the spillovers arising out of the US Fed rate hike or what the other advanced economies will do. You see, it is varying from, it is it remains quite mixed. ECB has started what they call they're reducing their asset purchase. US is also reducing its asset purchase. But so far as India is concerned, we stopped our asset purchase in October last year. That is the Government Security Acquisition Program, the GSAP, which we announced, that again started in April, ended in October. So therefore, we are really in that way, in that sense, we are ahead of them. This is a little realized fact. People think that we are falling behind the curve. No. We started asset purchase at a particular date, we ended it on a particular date. With regard to interest rates, if you see, the language is different from country to, it is varying from country to country. Two of the largest economies in the world, they are pulling in different directions so far as monetary policy is concerned. One is on a tightening mode, the other one is on a loosening mode. PBOC did not raise their bank rates yesterday. US has announced the rate hike. So there can be some spillovers, but whatever are the spillovers, I can say with reasonable amount of confidence that we will be able to maintain the stability of the Indian rupee. In fact, our interventions in the foreign exchange market, if you see, it is the standard policy. Our standard policy is that we intervene to prevent excessive volatility. And the current financial year till last Thursday, today, I didn't have time to take out the number today, but till last Thursday, Indian rupee depreciation vis-a-vis the dollar in this financial year from 1st April last year till last Thursday was 17th of March. It was minus 0.4%, less than 1%, less than 0.4%. The depreciation was not minus, depreciation was 0.4%. So we have been able to maintain the stability of the Indian rupee going forward. I think our Forex reserves and our ability to finance the current account deficit, again, inflow of FDI is also expected. I think there was a mention made about it. So with that, we will be able to, it will be our endeavor and we should be able to maintain the stability of the Indian rupee. Now coming to Uday's point about both the two lines, I think both the lines mean the same thing. One is explicit, the other one is implicit. The first line, Jine ki tamanna, is very explicit. The second line, Marne ka irada hai, is because she is so happy that she doesn't care if she dies. So there, the optimism is implicit.
Thank you. Mr. Keki Mistry, Keki, yeah.
I just like to say that RBI has done a phenomenal job and thank you so much for that. I talked to so many foreign institutional investors and they are extremely complimentary about the role RBI has played right through this pandemic. I just have one suggestion, which is with regard to affordable housing. Now, as you know, housing is one of the biggest parameters to economic growth because there are so many multiplier impact that housing has, whether it's on cement, steel, paint, power, all of that. So the amount of money, the amount of funding required for affordable housing is actually huge, it's massive. Now, one of the avenues of raising money for affordable housing is through the ECB route, the external commercial borrowing route. There we have a few suggestions and I'd be very happy to come over and give you a note on what those suggestions are.
Thank you. Pawan?
Thanks, Naren. Ms. Das, I'm sure most of the people are going to be praising you for what you and RBI did over these 2 years, which really has kept the economy afloat, and some sectors of the economy have bounced back. Like you did mention, some are still in orange. My own industry, two-wheelers, is still struggling, not able to come out after the second wave. So we do look forward to continued support for those sectors to also bounce back. A quick question. There is there is a risk for the global economies to go into stagflation. And India being now an aligned economy with most global economies could also get there. If that was to happen, what would you and the RBI do, and what would your recommendations be for the membership of CII here?
Thanks, Pawan. Sachit?
Sir, my congratulations also on wonderful stewardship in these tough times. Sir, a question looking forward. Do you think a time has come that to look back, that when we changed from WPI to CPI and set a target of 4% with a variation of band of 2%, which means sometimes 2%, which can be extremely low inflation. Maybe for a developed country, yes. Would there be a case in the future to revise this target of 4%? Maybe give more leeway, maybe 5, 6 or whatever with that band. So, because even in very low inflation, the increments in the corporate sector you will check are 8 to 9%. And when the inflation is high, it goes up to 11, 12%. So really the real costs on wages are increasing even when inflation is very low. Thank you, sir.
Is with regard to affordable housing, I would request Mr. Keki Mistry to please send me a note, and I will go through it. I will ask my colleagues also to have a look at it. And if required, we will have a discussion also with you, and we will see what can be done about that.
Thank you, sir.
So thank you for your, inputs which you have said that you will provide. I will wait for your note. With regard to the prospect of a stagflation, whether it is a risk for India. Now, in our assessment, I think such prospects don't exist, because I think India is far away from such a grim prospect. So far as European economies are concerned, whether it is the most advanced economy or the European economies, you have to take into account what is their inflation target and where their inflation is. United States, for example, their target is 2%. And today they are almost touching 8%. 7.9 was the last figure which was released. That was the last print. Similarly, in Europe and other countries, you see that the inflation is way above their target, which is mostly 2%. So far as India is concerned, as was mentioned, our target is 4 plus minus 2. So up to 6%, we are still within the range. For last 2 months, it was 6%. We do expect the inflation to moderate going forward, but on inflation, as I said, we will spell out our inflation roadmap. I mean, what is our estimation? What is our expectation in the monetary policy? So I don't see a situation of India, where the inflation keeps on exceeding the band which we have, 2 to 6%. So therefore, that is not, that is, I think, a very, very remote possibility for India. And Indian growth also, this year's projection is 8.9% for the current year. And no, sorry, that's for the current year, 8.9%. And even if you factor in the impact of the Ukraine crisis, etc., it will be very marginal on that. Again, the numbers I am not commenting whether 8.9 will become so much or it will not become so much. It will be still remain at 8.9%. That is something which I would leave for the next monetary policy. And in any case, our internal exercises and analysis is still going on. And I can't really say any number today, not just because of MPC confidentiality issues, but because those numbers are still on the drawing board. So India, I don't see the inflation and inflation going up beyond 6%. And in fact, our expectation was that it will moderate to 4.5%. Now, when we rework, we will know exactly where we stand, whether it will be higher than 4.5% or it can still be 4.5%. And also, let us remember that when you are making assumptions on crude and commodity prices to calculate the inflation, you assume a figure and you assume that it will prevail for 365 days. Now, we don't know today whether crude oil will remain at $100 plus till the end of March 23. I mean, it can come down, it can also go up. So the situation today is unimaginably uncertain. In fact, the OECD in its latest report yesterday, in their analysis, they have not given any number with regard to inflation or growth because they say that it is very, very uncertain and it will be difficult to give any number. If you remember, in the beginning of the pandemic also, we had stopped giving any growth projection because the situation was so volatile. But with all the volatility, with all the uncertainties, India, as far as I can see, and as far as I understand the problem, and as far as we see it in the Reserve Bank, the prospect of a stagflation, so far as India is concerned, does not arise. I can be as clear as that. Now, with regard to WPI and CPI, the RBI had appointed a committee in 2014, which worked on this inflation targeting. And it was that time seen that, sometimes it is very difficult to reach a particular number. For example, if you say my target as in advanced countries is 2%, now it can be a little above or a little more. And then there are situations of stress, acute stress and extraordinary unforeseen situations which come up. In fact, it is our target band. It is the flexible inflation targeting with the flexible band between 2 to 6%. That is what enabled the Reserve Bank to provide all the monetary policy accommodation and the reliefs that we have provided over the last 2 years. Instead, if it was just a 4%, we would not have the flexibility to do most of the things as we have done. So a flexible inflation targeting whereby you don't have a particular target of 4, but your failure is if it falls below 2% or if it is higher than 6%, that flexibility, and also flexibility to the extent that it is not 4% in a single month. It has to be 4% over a period of time. For 3 consecutive quarters, if we are, falling outside this target band, then only it is considered as a failure of a monetary policy. Now, the committee which had gone into it had seen, according to their analysis, any inflation above 6% will be negative for growth. So that is why the upper band is kept at 6%. And 4% was considered as an optimum number at which there is an optimal balance between inflation and growth. So that is why 4% is a very well considered number. In fact, in our currency and finance report, which we published in January or March last year, I think we published it in the month of March, probably. The currency and finance report, which used to be published earlier, but had been stopped, we revived that. It's available in the RBI website. It's a detailed documentation and detailed analysis has been presented about the rationale of this 4% plus minus 2%.
Thank you. We are now on borrowed time, so I would request the questioners to be brief. We were supposed to finish at 5:30. Mr. Das has agreed to stay on for some more time. Vinayak?
Mr. Governor, today the National Bank for Financing Infrastructure and Development, the new DFI, NABFID, is probably emerged as one of the most significant measures that the government has announced in recent times for financing long-term projects in infrastructure. And I would also join the chorus of thank yous for the speed with which the institution was created with a wavelength match between RBI and the Ministry of Finance to structure this institution. The question is, as far as we understand, the leveraging capacity of this institution is the same as current banking norms, which broadly means that it can leverage 9 times. Now, with an equity capital of 20,000 crores, which the government has transferred, and another 5,000 crores, which is due anytime, 25,000 crores of equity with a 9 leverage would allow this institution to raise 2.25 lakh crores. That is grossly inadequate for 2 reasons. One, the expectation is that this institution would be, in the short term, able to provide short term, I mean in the next 2 to 5 years, 5 to 6 to 7 lakh crores for the infrastructure sector. And secondly, developmental financial institutions all over the world, and the Chinese Development Bank is a key example, at the peak infrastructure build of China had leveraged itself above 60 times its equity. Now, the question for you is, are you going to restrict this institution to 9 times leveraging, which means it can only do 2.25 lakh crores and stifle economic growth? Or will you allow it, being a 100% sovereign-backed institution, to actually go at much higher levels of 10, 15, 20? That's the question.
Thanks, Vinayak. Janmay?
Governor, I'm very happy that Vinayak asked that question. The question that I have for you is that looking at what's happened with the Russian reserves, how comfortable are we with our foreign exchange reserves? What comfort do they actually provide in the face of any type of sanctions, given the dollar-backed nature of the global financial system? And what could we do to alleviate some of these risks?
Thanks, Jayant.
There are few sectors of economy which obviously bring in very differentiated kind of returns. You said very clearly that the current war, all small countries essentially will feel threatened and will want more and more investment to go into security. When we start looking at security, last 5 years back, there was nothing like defense export. It started built up to about $1.5 billion. And last 2 years, thanks to the COVID, it's fallen by about 40%. When we start looking at the world, we see only China and India really wanting to go big way in terms of some of the small countries export. My belief is our rate of interest, specifically for these kind of sectors which have huge diplomacy benefits on the defense front, there is a room for actually doing better financing them for the working capital. Of course, today, there is no mechanism to do that. One possible mechanism we all thought was to actually take out 1% of the reserves that we talked of. We are at extremely good position on that, purely for dollar inflow, lend money at international rates. We then can take on Chinese, we then can do some good amount of exports.
Now, so far as the NAFID, that is the National Bank for financing infrastructure development, so far as NAFID is concerned, it's the beginning. 20,000 crore is the beginning. And I don't think that's the end of it. So going forward, depending on utilization, I think the government, it's open to the government. I can't speak on behalf of the government, but it's open to the government to step up that, beyond 20,000 crores. So that option is always available to government. With regard to leverage 9 times, you see, the risks also have to be factored in. Even government, so far as the fiscal side is concerned, while there is increase in capital expenditure, last year budget and even this year's budget, and while there is a fiscal expansion, but the government is also equally mindful about the debt to GDP, the overall debt burden, because otherwise the interest cost, the interest charges, the outflow from the budget for interest payment itself will become so much that your current expenditure will suffer. So every authority, whether it is a fiscal authority, the government, or the central bank, we have to also, while focusing on growth, while focusing on development, we have to also look at stability and long-term sustainability of all investments. So today we want high infrastructure development, but what consequences it has on the stability of the economy? After all, we have to, as a central bank, we have to look what will be the position 3 years down the road or 10 years down the road. So we have to factor in stability issues, and we have to also look at sustainability of every investment. So sometimes a rush for higher investment, throwing the stability aspects, or completely ignoring the stability aspects and sustainability aspects would be, not sometimes, it would be generally be counterproductive. So we have taken a very considered call. And in any case, you said a figure of 2.25 lakh crore. As I mentioned, it is, it's not the end of, it's the first lot. So going forward, it's open to the government to sort of do more in this area. And I'm sure if the time requires, if the situation warrants, they will do it. With regard to sanctions versus reserves, you see, our reserves are quite well dispersed. And I don't foresee a situation whereby India will ever face a sanction situation. We are a democratic country, rule of law prevails. And India doesn't have any expansionary ambitions. This is something which I think the government has stated. These are not my words. In any case, I am not in a position to say that. It's for the government to say. I'm just quoting what the Prime Minister said, last year when he visited Ladakh. So I'm just quoting what the Prime Minister of the country said in Ladakh, that, we don't believe in expansion. So we don't have that kind of a situation. Our reserves are distributed in various foreign currencies, not just concentrated in one currency. We have gold reserves, which are also dispersed partly in India, partly outside. So it is quite diversified. And sanctions, we don't foresee that situation. But yes, it is something which going forward, I think every country will now start thinking about it. But the other issue is that you hold your reserves as what? Are you going to move to a complete gold holding, a complete shift towards gold? The liquidity also has to be seen. But I think why talk of a problem which is not there? And these are issues which I think are best left to the central bank to deal with internally. And I can only say at this point of time that our reserves are quite, well distributed in many currencies. But yes, the leading currency has the majority of it, without doubt. I mean, dollar, most of it is in, lot of it, I would say, is in dollars, but it is also in other currencies. And we have decided to diversify, not now. Some 6 months ago, we decided to diversify into other currencies also. So I don't see that as a problem. With regard to defense exports, if defense expenditure in other countries go up, traditionally Europe and all have not been spending much on defense. But I think if defense budget in those countries goes up, then it is an opportunity definitely for the Indian defense manufacturers to export our products. India has already made a beginning in this direction. And many of the companies are already, they have been exporting for last several years. So it is an opportunity for our export sector. Now, about use of Forex reserves, now, the first thing is, let us remember that the reserves is not our money. It is against a liability. It is against a liability. There is a, the country has certain liabilities also. Today, our foreign exchange is more than 100% of our external, debt. But the situation varies. Currency revaluation takes place. Gold revaluation takes place. Sometimes internationally, the other currencies become more, they appreciate vis-a-vis the rupee. The price of gold goes up, it comes down. And reserves are something which, which render lot of stability and confidence in any economy. Today, I am able to say there with, great amount of confidence that we will be able to deal with any spillover effect because of our $677 billion US. So that is, that represents the strength of our economy, that represents the stability of your, of your economy and exchange rate, your stability of the exchange rate and the sustainability and the strength of your economy. So therefore, touching the reserves for financing various requirements of the economy are not at all advisable, and they are not in the medium term, forget long term, they are not even in the medium term interest of any government. I'm not just saying India, but for any government. Some countries have done it, But I think in India, we today, according to RBI's assessment, I think India should not do that, and we are therefore not in favor of it. Thank you.
Thank you, Mr. Das. I know there are a long list of people who wanted to ask more questions, but we are totally out of time as far as Mr. Das is concerned. So I'll request Sanjeev to make some closing comments. Yeah.
Thank you, Governor, and thank you for this first physical meeting that you're doing with CIA. We appreciate that. Also very much appreciate your clear, candid, and categorical thoughts and discussions today. These 3 C's, very important, especially coming from a central bank governor. We are also grateful, as you said, to the RBI team for working through these last 2 years for ensuring economic stability for all of us and supporting this country through COVID. And also for acknowledging the need of an accommodative stance towards growth and not to change that prematurely. As with everything else that you do and RBI does, the consultative process that you have encouraged that help you take your decisions, once again, is something that we clearly note and appreciate. We all as industry understand that there will be an end date to the support that has been given. And as you said, each initiative of support has come with an end date. But we also appreciate giving this glide path. That is what we need to align ourselves to the expected change. Finally, as Indian industry, I'd like to say, जीने की तमन्ना है, मरने का इरादा नहीं है. Ladies and gentlemen, please join me in thanking the governor and his team